For the whole year 2020 and the beginning of the year 2021, the VIX, the fear index, was around the 30s, the 20s, and there was not really a fear of a potential market crash. However, now the VIX is around 15 or 16, back to normal levels, and actually it's during that time when the volatility is actually quite low that it's the riskiest time to trade, because you never know when a crash is going to happen. And the VIX went from, for example, 15 to 85 in February 2020, and that really shows how an unexpected move like the March 2020 crash can always happen. And because of that, you need to have a plan to hedge yourself against potential crash. You cannot just trade too big, because you might have your account blown up if a big movement was going to happen. And that's where credit spreads can come in. Credit spreads are a great way to protect yourself against, for example, a 2 standard deviation move, a 3 standard deviation move, and it can be really an amazing strategy so as to protect yourself from a potential crash. And in this video, I wanted to show you my thought process, because there are plenty of ways to trade credit spreads, and I wanted to show you another way of trading credit spreads, which I think is probably the best way to trade credit spreads overall. But before diving into this video, if you find this video interesting and you'd like to see more videos like this one where I share how I personally think about some strategies and how I plan to hedge myself, for example, don't hesitate to subscribe to my channel and liking this video. That's really the best way to let me know that you'd like to see more videos like this one, so I know in my analytics which types of video you like and which type of videos you'd like to see more. But first of all, before really diving into my thought process, I want to do a small reminder of what is a credit spread. So maybe for those who are not necessarily familiar with credit spreads, we are all on the same page. So a credit spread consists in selling an option and buying an option that has a lower value. And why is it important that it has a lower value? Well, because in the name credit spreads, you see that there is credit, and that means that you're going to receive money because you're going to short options overall. Hence, if you sell an option and you buy an option that has lower value than the one that you sold, then you're going to be in a net seller position. That's why we said that it's a credit spread, because you're receiving money, you're receiving a credit. And then when you're going to close your trade, you're going to pay a debit. That's why we call that credit spread. And that's why there is also a strategy called debit spreads, because when you open your position, you're paying a debit. And in our case of the credit spread, you're receiving a credit. That's why we call that credit spread. And I want to show you some examples of credit spreads so it's completely clear for you, because I know that just talking about it isn't necessarily helpful. In general, we like to see some examples. So let's dive into Testworks to see what are some examples of credit spreads. So right now we're in the Testworks platform and I've chosen the stock Tesla. And I'm going to show you the different types of credit spreads that there is. So if you want to use it yourself, you can also do it by yourself. So let's say that, for example, when we look at Tesla chart, you see that right now it's at $739. Let's say that you're bullish. So in that case, if you wanted to express your bullish view using a credit spread, you would need to sell a put credit spread. In other words, if we go back into the option chain, in other words, it means that you're going to sell an option and then buy a further at the money option. For example, let's say that we buy the 610 strike. So what you see here, and that's what I was saying, you're going to short an option and then you're going to buy an option that has less value than the one that you short. For example, here we see that the option that I sold, you see that I'm going to collect around $50 of credit. And you see that the option that I'm buying at the 610 strike, I'm going to pay around $25. So you see that overall, I'm going to receive a net credit of $25.45. And you can see here in Testworks, it shows net credit because you're shorting more than what you're buying. So you're receiving a credit and here of $25.45. And if we look at, for example, the P&L graph showing where are you going to be in terms of profit or losses if the stock was moving. So in our case, you would see that at expiration, because that graph is really at expiration. If at expiration the stock is above $665 per share, then you're going to be in a profit at expiration. You see that there is this P&L EXP, that's P&L at expiration. And if the stock goes below $665 per share, then you're going to be at a loss at expiration. However, let's say that you wanted to use a credit spread, but this time you're bearish on Tesla. In that case, you need to use what we call a call credit spread. So for example, here in our option chain, you're going to sell a call and you're going to buy a call at a higher strike, and so at a lower value than the one that you shorted for. So for example, I'm shorting the 760 strike and I'm buying the 830 strike. So in that case, you see that I receive once again a credit of around $25, and you see that it's a credit meaning that I'm a net seller overall. And once again, if we look at the P&L graph, you see that our max loss is capped, meaning that if the stock continues going higher and higher, we wouldn't lose more, because by buying that long option, whenever you're using a credit spread, by buying that long option, you're going to cap your max loss and you're not going to lose more money compared to if you were only, for example, shorting a call and you wouldn't have that long leg. So let me delete it. Then you would theoretically have an unlimited loss. That's why, for example, shorting a naked call can be quite dangerous, because if the stock, let's say, shoots up, you could lose a lot more than what you actually put in, and you have an unlimited loss when you're shorting a call. That's why using a call credit spread might be a better option, because you're capping your loss. So as you saw, there are basically two types of credit spreads. Either you're going to be bullish and so use a put credit spread, or you're going to be bearish and so use a call credit spread. Or for example, and that's going to be for another video, I don't necessarily going to cover it here, but if you are, for example, neutral, then you can sell a call credit spread and a put credit spread at the same time, and it's going to give you what we call a short iron condor, where basically you bet that the price is going to stay within your strikes. And really, if you had to remember something about credit spreads, first of all, without even thinking about anything else, even if it's rolling, even if it's defending trades, whatever, it's that you want to use credit spreads because you want to cap your max loss. For example, let's say that you're afraid that a crash is going to happen. Instead of, for example, selling a naked put and so having a lot more capital at risk, you can use a put credit spread so as to cap your loss. So even if there is a crash, you're not going to be in that bad of a situation compared to if you had sold only naked puts, for example. And now that you have the basics of credit spreads, let's get to the interesting part and how I personally think of credit spreads and how I use them and how I'm going to use them, especially for the future, now that the VIX, the fear index, came back so low. I think it's around 15 or 16 now, which is quite low when you think that before, during 2020 and during 2021, the VIX was around the 20-30 level. So I use credit spreads really as a hedging tool. What does that mean as a hedging tool? Well, it basically means that if there is a crash, I'm not going to be in that bad of a loss. Or for example, if the stock shoots up, I'm not going to be in that bad of a loss. Because usually what's being done with credit spread is that, you're going to keep a very tight width of the strike. It's going to be quite tight. And for example, if you look at Tasty Trade, they have this rule 1/3 of the width of the strike. And I agree that it can be a nice way to trade credit spreads. However, I think that there is also some very good ways of trading credit spreads, and let me explain it to you. For example, here I'm back in the Tastyworks platform and I've simulated, for example, a potential put credit spreads. And that type of setup where you see that the long leg and the short leg are quite close to each other. You see that there is only 20 point wide, and compared to before where I was making a width of the strike that was a lot bigger. Here you see that it's quite tighter. And that's usually how people are going to trade credit spreads. That's usually how it's going to be done. The good thing about trading credit spreads that have a very tight width of the strike is that you're going to have a smaller loss compared to if you were making your width of the strike very big. For example, if I was moving my long option that is at the 650 strike, let's say to the 580 strike, you see that my max loss on that trade would be of $6,580 compared to before. If I come back to where it was before, you see that my max loss on that trade would be of $1,330 maximum. So as much as this type of setup where you have a smaller max loss might seem very attractive because you're like, well, I'm going to take on less risk, so why not just doing this? Well, the very big problem that is going to cause you a lot of headaches, and I know it because I've been really through it, is that with this type of credit spread where you have a very tight width of the strike, it's going to be very hard for you to do anything if the trade goes against you. And what I mean by this is that when a trade goes against you, for example, if you have sold a naked option and the trade goes against you, you have the possibility of what we call defending your trade, and that's called rolling your trade. What does that mean, rolling your trade? Well, it means that you're going to basically close your current position, take your loss, and set up a new trade, sell another option that has the potential, because you collected a credit at the same time, so it has the potential of recouping your previous loss and making a profit on top of that. That's why we roll trades. We roll trades so as to take our loss and set up a new trade that has the potential to regain all that previous loss and even make a profit on top of that. However, and that's where it gets interesting when we talk about credit spreads. When you have a credit spread that is, for example, that tight, or let's say even tighter like this. Let's say that I was selling the 670 strike and I was buying the 660 strike. You'd see that I have a max loss of $645. The good thing yes, you have a max loss that is lower than what we had before, for example, with our $6,000 possible max loss. However, if the trade goes against you, you're not going to be able to hold that trade for a credit. You're not going to have the possibility to defend that trade. So whenever you place this type of credit spread, know that it's either going to be a winner or it's going to be a loser. But you're not going to be able to do anything with that credit spread after you've placed it, because you're not going to be able to defend it, because you will never be able to hold, or almost never be able to hold, this type of credit spreads with very tight width of the strike to a later expiration, all of this for a credit. And rolling for a credit is very important because it means that you're selling a new credit spread that has the potential of regaining your previous loss and making a profit on top of that. And that's where I'm going to use credit spreads in a different way. Here's how I'm going to use credit spreads personally. Instead of having a very tight width of the strike like this, I'm going to make my width of the strike a lot bigger than this. So for example, if I was placing a credit spread on Tesla and I was bullish on Tesla, I would, for example, sell the same option, the 670 strike, but instead of buying the 660 strike, I'm going to move my long leg a lot further out the money. And actually, I'm going to move it, let's say, around the 5 delta. So for example, in our case of Tesla, it would mean, for example, that I'm going to buy the 460 strike. And you see that I'm going to pay $6 to buy that long option, compared to before. If I was like keeping my long leg where it was before, the 660 strike, I would pay $40 for my long leg. But why am I doing this? Why am I buying a long leg for my credit spreads that is so far at the money? Well, the reason I'm doing this is very, very simple. Think about this really as an insurance. Whenever you're trading credit spreads, you're basically buying as a long leg. It's an insurance in case the trade goes against you. And by buying a long leg that is so far at the money, I'm basically saying, look, I'm going to buy an insurance where in case of a crash, I'm going to be covered. And it's only if there is a very big crash that I'm basically going to be profitable on that long option. But I don't really mind. I want to have that long leg very far at the money that I'm not really paying a lot of money for, because I know that if there is a crash, it's going to take enough value so as to offset my losses and cap my losses. And I will be able to keep the great benefit, which is I will still be able to defend my trades, because my long leg won't take a lot of value. I won't have a lot of troubles rolling my trade to later expiration for credits. And that's really the key. I cannot stress that enough. The fact that I'm able to roll my trade to later expiration for credit by putting a credit spread that has such a big width of the strike, because I'm not paying a lot of money for that long leg, is going to allow me to do basically two things. It's going to allow me to almost keep my full premium of my short option, because remember that the premium that you're selling on your short option is your max profit. That's the potential max profit that you could make on that trade. By buying a long option that is very far at the money, I'm going to reduce very slightly my maximum profit. I'm not going to reduce it that much. And on top of that, I'm still going to be able to defend my trade if the trade goes the wrong way. So you would maybe ask me, well, what's the point? Because if the trade goes against you, you're not really going to protect yourself. Why not just putting your long leg and your short leg closer together so you can just make more money and you're not going to have that big of a running loss? Well, the answer to that, and that comes back to rolling your trade, is that when you have such a tight width of the strike, you're not going to be able to defend that trade, to roll that trade. And what I mean by this is that whenever you place a credit spread that has such a tight width of the strike, you really have to understand that it's going to be a winner or a loser, but you're not going to be able to do anything with that trade if it goes against you, compared to a very big width of the strike where yes, you have a bigger potential running loss that you're going to have in the moment. However, you will be able to roll that trade to a later expiration and recoup all of those losses and even make a profit on top of that. And I want to take the SPY as an example. So the SPY, for those who don't know, is the S&P 500 ETF. And for example, the March 2020 crash is a very good example of what could have happened if you had a very tight width on a credit spread compared to a very big width. If you had a very, very tight width of the strike on a, for example, let's say that you had sold a put credit spread just before the crash, then you would have had to take your loss and basically that's it. That would have been it. However, if you had sold a credit spread with a much bigger width of the strike, then you would have been able to roll your trades, and because the market came back so quickly, in the span of 2-3 weeks, you would have made all of your money back and even made a profit on top of that. That's why selling a credit spread that has quite a big width of the strike is so great because now you keep the benefit of making money because of your short leg, because you don't pay a lot of money for your long leg, and so you still have a lot of potential profit, and you still keep the benefit of being able to roll your trade if the trade goes against you. And on the downside of that is that yes, it's true, you're going to have a potential running loss, and if the trade goes against you, that's still going to be a big running loss, but because you are able to roll that trade, if you give yourself a bit of time to be right, usually you're going to be right. And you're not going to be in that big of a loss, because if you had sold, for example, just a naked option, you would have been in a much bigger loss than this. So it makes complete sense, especially for the SPY. I want to show you a practical example of a credit spread and what it would give if, for example, a crash was happening, what would be the running loss, and how you would need to deal with this. If you were, for example, just selling a naked put on the SPY, meaning that if you sell a naked put, it means that you're bullish. I, for example, took the example of the 402 strike, and let's say that we pretend that we're going to sell a put at the 402 strike. You would make a potential profit of $598 max profit, and let's say that the SPY falls. Let's say that, there is like a black swan event and the market starts crashing. Let's imagine that the SPY falls, let's say, to 300, and now it's at 417. So let's say that it was falling to 300, which would be around that level. It's true that it would be a huge loss, but it's not impossible. Let's see what would be your running loss if you had sold a naked put and the SPY would fall at 300. If we look at the P&L graph, you would see that at expiration, I would have a loss if the SPY was falling at 300 of almost $10,000. So you would see that after that, if you have a lot of capital, you're able to roll this and it's really not a lot for you, then fair enough. However, if you're not comfortable with this and you want to protect yourself and still be able to defend your trades, let's see how we would compare if you were selling a credit spread that has a very big width of the strike. Now we're back on the same P&L graph and you can see that I have bought, for example, the 343 puts. You see that I'm paying $1.11 for this, and if the SPY was falling to 300, then I would be in a max loss at expiration of $5,410. So you can see that between my previous running loss, which was of almost like $9,500, and this one of $5,400, it's actually quite a big difference. You're not making that much less profit. You're making potentially $111 less profit, potential profit, compared to if you had sold a naked option. However, if the market crashes, you're going to be at a capped max loss and you're still going to be able to roll your trade for credit and potentially recouping all of those losses and even making a profit on top of that. And that's why I really cannot stress enough that credit spreads, if you want to use them like this, I think it's an amazing way to use them like this. And I think it solves in a way the big problem that usually when you have a lot of upside, you also have a lot of downside. And with credit spreads, when you sell them and they have a very big width of the strike, then you're really gaining on both sides. You're really winning on both outcomes, because yes, you might have a running loss, but that wouldn't be different and that would actually be less compared to if you had sold a naked option. You would still be in a running loss, it's true. However, your loss would be capped and you would still be able to roll your trade and even make that after. So why not selling credit spreads that has a very big width? And I think that when you have the VIX that is so low now, it's around 15 or 16, I think that when the volatility is low, it's actually the riskiest time to trade. When we were in April 2020, just after the March crash, it wasn't necessarily the moment where we're all afraid of a crash because the crash just happened. So of course, it could always happen another one and there could be another one, we never know. However, we know that it wasn't necessarily the moment where we thought that another crash would happen because it literally just happened 1 month before. It's actually in times when nothing happened for a long time that you can think that it's actually way riskier to trade, because now we start entering times where the market just went up a lot. The SPY is now at 417. I mean, the market almost doubled in the span of a year. It's really crazy in what markets we are right now. That's why I think that capping your max loss by using credit spreads that have a very big width of the strike is maybe going to limit a bit your potential profits. However, the safety that it gives you, I think, is well worth it. And I'll definitely post in the next days or in the next weeks like examples of credit spreads and how I manage them, so you can have like real life examples. I hope you enjoyed this video about credit spreads, and I try to bring you another view of what we typically see. For example, with credit spreads, usually we tend to see credit spreads with very tight width of the strikes, and I wanted to give you another view of credit spreads and what is is personally, in my opinion, probably the best way of using credit spreads. If you found this video interesting and you have any questions, just don't hesitate to comment it below. I'll be happy to answer any questions that you might have. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.